business accounting, financial accounting. In last class of our financial accounting, we have completed third 3 units, and today we're gonna start with unit number 4, which is accounting standards. So now I'm presenting you the book and turning off my camera. Please stay focused. So yes, it's unit 4, accounting standards. So what is accounting standard? Anyone? Let other students go. Okay. Now I'm the class. So accounting system. Basically, it refers to accounting principle, rules, and regulations, or the norms we use to create accounts. Okay, to create accounts. So these are accounting standards. Whatever rules or regulations we have, which we use while creating the accounts of P&L account, balance sheets, purchases account, and many types of account. So whenever we use the rules of accounting, then it comes under the accounting standard. Wait. Yes. Now, accounting is the language of business. All financial information, that is nature of financial activities, financial position, financial results, present trend, and further the prospects, etc., are available through accounting only. Okay. So we have some generally accepted rules and regulations of accounting. So whenever we use those rules and regulations, basically we are using the accounting standards, or we are following the accounting standard norms. So that's what is accounting standard. We have mainly three types of rule. First is GAAP, which is GAAP, GAAP, and its full form is Generally Accepted Accounting Principle. Generally Accepted Accounting Principle. It's given by IFRS, which is International Financial Reporting Standards. Okay, uh, almost 120 plus countries follow this concept, which is IFRS and GAAP concept. 120 plus countries worldwide has accepted this. The second one is Indian Accounting Standards. Okay, IAS, Indian Accounting Standards, which is called as Indian GAAP by, and it is given by ICAI, Institute of Chartered Accountant of India. Now coming to the definition of accounting standard and nature of the accounting standard, you can read it here. The accounting standard may be defined as the accounting principles and rules which are to be followed for various accounting treatments while preparing financial statement or on uniform basis, and which will reveal the same meaning to all the interested groups who will use the same. So this is the definition of accounting standard. Basically, these are the rules and regulations of accounting which every accountant follow to prepare the accounts. Nature of accounting standard. It serves as a guide to accountants. Like, if there were no accounting standards, then how can a person, how can a person prepare the account? How can an accountant prepare a account if he or she doesn't know about the accounting standards? What are the norms of accounting? What are the rules of accounting? Okay, how to record a transaction, how to present it in the ledger, how to transfer the journal entry into the ledger, then how to calculate profit and loss, okay, how to present balance sheet, and these are the norms which accounting standards tells to a accountant. It act as a dictator. Accounting standards act as a dictator. Like, we have to follow the rules. Like a balance sheet, when we create a balance sheet, then it can be vertical or horizontal. And if we are creating a vertical balance sheet, then we have to follow the accounting standard of vertical balance sheet. But if we are creating a horizontal balance sheet, then we have to follow the rules and regulations comes under the horizontal balance sheet. So it acts as a dictator. It acts as a harmonizer. Like almost every organization follow the same accounting, so follow the same accounting format, and we can compare it. So when we use same rules of accounting, same regulations, same same norms while creating an account, that's why only we can compare it to the other company, okay, to other company accounts. So it gives us the uniformity. It it creates, or it helps us to read the accounts. Otherwise we won't be able to read the accounts of a company. What are the benefits of accounting standards? Like uniformity is the benefit of accounting standard, okay. And it prevents fraud and accounting manipulation. It prevents fraud and accounting manipulations. How it can prevent frauds and accounting manipulation? Anyone wants to try? How can accounting standards prevent fraud and accounting manipulation? Anyone want to try to explain this point? Okay, let me explain it for you. So we can also prevent frauds and accounting manipulation because, as per accounting standards, it is mentioned that we should not record any transaction which doesn't have an invoice or cash memo or the bill. So we can be prevented. We can prevent frauds and accounting manipulations. An accountant can't show the transaction which haven't happened in reality until or unless he or she have the cash memo, okay, the invoice. So that's how it prevents frauds and manipulation. Standardized accounting, because it is universal, it creates accounting, it makes accounting standardized because it is universal. Every country almost, like 120 plus country is following the IFRS rule, the IFRS rule. So it is creating a standardizing account. It's creating a platform where every country can prepare their accounts using that method. International accounting standard. The FASB is advantageous because it actively promotes an internationally recognized set of accounting rules. Like globalization has deeply connected foreign financial market, a standard set of accounting rules would make financial reporting more accurate and fair between countries because it facilitates smooth relationship between two countries, between two companies of different countries. When two companies of different countries dealing with each other, then it is necessary that they share a common accounting standard. It is necessary that they share a common accounting standard. So this is the benefit which accounting standard is providing us. Procedure for issuing as in India. Like how an accounting standard, how a norm or a rule is made in India. At first, we determine the need of an AS. AS is stand for accounting standard. AS is stand for accounting standard. Okay. So first, we determine the need of an AS. Like, why do we need an accounting standard? To create a systematic accounting environment. Okay. To create a systematic accounting environment, we need a accounting standard. So the second step is constituting a study group. Constituting a study group. Then we will constitute a study group which have certain members which will look in that matter. Okay, who will look in that matter. Like Institute of Chartered Accountant of India have some members. Okay, we create a team out of some members. We create a team out of some members. Then they will look for the motive behind the need of accounting standard. And the third step is drafting the standard. In this step, they draft a standard, like they objectify the standard. They see the scope. They write the scope of the standard. They write about the standard, how we can use it. Okay, we recognize and measurement principles, presentation and disclosure requirement. In fourth step, we analyze that draft. Why it is called drafting? Because the it is not created an accounting standard here. That's why it is known as drafting. But when we go to the analyzing state or analyzing step, then in this step we consider this accounting standard, and basically we test the accounting standard. Is it required or it is not, or it is perfect or it does need some changes. So we analyze the draft. After passing from the analyzing the draft, it go to the circulation of draft. The steps comes circulation of draft. We circulate this draft, the AS draft, to the council member of ICAI. To the council member of ICAI. We share the draft to the council member of ICAI. Now the authority will look after. Authority will look after the draft. Okay. Now they will examine this draft and they will provide their opinion and recommendation regarding this draft. And in the next step, holding a discussion and finalizing exposure draft. Holding a discussion and finalizing exposure draft. The Accounting Standard Board holds a meeting with the representative of the above mentioned bodies such as like Reserve Bank of India, Indian Bank Association, Central Board of Direct Taxes, all these authorities, they will have a meeting with all of the authorities and that determine their views on the draft accounting. And then they will determine their views on draft accounting. And based on the analysis of discussion, Accounting Standard Board finalized the exposure draft of proposed accounting standard. And in next step, we will move to circulation of exposure draft. The exposure draft of the proposed standard is issued to the comments to the member of ICI and the public. Now it will disclosed to the public. Like we are creating this rule for accounting or this standard for accounting. Then public or the ICAI further give their response or comments to that draft. And the eighth step is finalizing the exposure draft. If the results come positive, then we will finalize the draft. And then the last step is modifying and issuing the accounting standard. Modifying and issuing the accounting standard. If everything remains positive, then we will issue this. Then we will issue this accounting standard, or we will apply or adopt this accounting standard. This is the procedure to adopt a accounting standard in India. Some features of INT AS, which is Indian Accounting Standard 101. See, in India, we have IND AS 101 lays out the accounting principle for the first time adoption of IND AS. It prescribes the various requirements to be fulfilled during the transaction period when a company adopts IND AS for the first time. But when it moves from making the financial statement in accordance with accounting standards like Indian GAAP to make them in accordance with Indian AS. IND-AS. We have some objectives of IND-AS as well. The first one is it states that is transparent for user and comparable over all period and present. Whatever Indian accounting standard says, it first says is that it should be transparent for user and it should be comparable over all the periods and presented. Second one is like it cost that doesn't exceed the benefit. Cost that doesn't exceed the benefit. It should provide a suitable starting point for accounting in accordance with the Indian accounting standards. It should provide a suitable starting point for accounting in accordance with the Indian accounting standard. Now, coming to the point, currently prevailing accounting standard in India. Currently prevailing accounting standard in India. See, Section 133 of Companies Act 2013 requires that the companies to comply with the prevailing accounting standard. As on 1st April 2016, there are 32 accounting standards. There are 32 accounting standards, 32 AS, specified by ICAI. Institute of Chartered Accountant India, all of which mandatory to be complied by the companies. All of which are mandatory to be complied by the companies. Please focus on the point mandatory. It is mandatory. Okay. Every company have to follow these rules. It's not a voluntary decision. At first, it was in 2015, but later our government have decided to create it mandatory. So we have some principles you can read. We are not gonna read all 32 AS accounting standard, but some out of them. Like AS1 is related with disclosure of accounting policy. Accounting standard 2 is related with valuation of inventories. Accounting standard 3 is related with cash flow statement, how we should create cash flow statement, what norms or rules we have to follow there. Okay. Accountancy accounting standard 6 is related with depreciation accounting. We should use SLM method, direct method. Accounting standard 5 is related to net profit or loss for the period, prior period items, changes in accounting policy. Just need to read these accounting standard points. Okay, accounting standard 19 says about the leases. So these were 32 accounting standard, which is mandatory for every company stayed in India. Which fulfill a certain norms or criteria. Now coming to the point, international financial reporting. International financial reporting standard. So these are the internationally accounting rules of recording of accounting. Okay, accounting provides companies, investors, regulators, and others with a standardized way to describe the financial performance of an entity. Accounting standards present and prepare so financial statement with a set of rules to abide by when preparing an entity's account, ensuring this standardization across the market. So, International Financial Reporting Standard, which is IFRS, International Financial Reporting Standard, which is IFRS, is a single set of accounting standard developed and maintained by International Accounting Standard, developed and maintained by International Accounting Standard Board, with the intention of those standards being capable of being applied on a globally consistent basis. Globally consistent basis. What was their aim? Their aim was to create such rules or regulation of accounting so that there will be a smooth transaction between two countries of different two companies of different countries, two or many more companies of different countries. So that's why any person can invest. Any person can invest in the company situated outside their nation. How can we invest in a company if we don't know about their accounts? Okay, if we don't know how to read the account of that company. Suppose if we don't know how to read the account of Apple company, if they were following different accounting standard, then how can we invest in that company? How can we purchase the shares of that company? So that's why IFRS made some rules and regulation which can be followed or accepted by different countries. And right now, 120 plus countries are following these accounting standard norms. Need and procedure for IFRS. Need and procedure for IFRS. I think need is clear because uh, our, these days globalization is happening. With the increasing globalization of financial market of companies, it is required. IFRS is required. Now coming to the point, the procedure. So IFRS, how they create accounting standard is like first they set a agenda, second they plan on the project, third developing and publishing the discussion paper public consultation, including public consultation. Developing the fourth step is developing and publishing the exposure draft, including public consultation. Whatever suggestion is given in the third point by the public or to the authorities by the authorities, then after changing those things, we redevelop and publish the exposure draft, including the public consultation. Now in fifth step, developing and publishing the standard, we publish the standard that this become a standard or accounting standard. In sixth step, we have procedures after a standard are issued. We just issue that standard. That's how IFRS create an accounting standard. Convergence to IFRS. See, for a country there are two options. For a country there are two options for compliance and implementation of IFRS. Okay, we as a country have two options. Either we can adopt these rules or we can convergence. We can have like we can create some necessary changes in those rules and then adopt it. Either we can adopt them as it is, okay, or we can modify them according to our needs and then apply in our country. So whenever we adopt IFS rules or accounting standards exactly as they are, then we it comes under the point of adaptation. oh sorry, adoption. But when we do some modification, some necessary changes in IFRS rule, and then apply those rules in our country, then that part is known as convergence. In India, we also have convergence in AS. Okay, that's why we call it IND AS, India Accounting Standard. So IFRS 2, the title of IFRS 2, which is an accounting standard rules, it tells you about the share based payment, the share based payment. But in India, we have INDS 102. We have created some changes, we have redeveloped it, okay, as per our needs. Then we published it to the public. So these were some points or accounting standards. Like I said earlier, in India, we follow the convergence rule, and on 1st April 2015, on voluntary basis of financial statement for accounting periods beginning on after 1st April 2015 with the comparative for the periods ending 31st March 2015. Okay, it was not mandatory till here. Like a company, if a company wants to adopt the rules or norms, then they can adopt. But if they don't want, then it's their right that they deny it. Okay, but in 2016, on after 1st April 2016, it becomes mandatory. Like some companies with certain rules and regulation, if the companies come in the criteria, like if they have net worth of 500 crore and more, if a company have net worth of rupees 500 crore and more, then it comes under the criteria. Okay, then they have to follow, it's mandatory, they have no other option, they have to follow that rules, that accounting standard. Now coming to the point, distinction between Indian AS and international AS. The distinction between Indian accounting standard and international accounting standard. First one is name. See, accounting standard and Indian accounting standard. When business were not that complicated and accounting was done at local level, then accounting standard based on local gap were enough. But Indian has, like today, business have become complicated and globalized world is in the need of a comprehensive accounting standard that can be consistently applied globally and facilitate compatibility. Now, objective. The basic objective of accounting standard is to remove variation in treatment of several accounting aspects. Okay, but if we come under the accounting standard, then it it means, or its objective is to create a uniformity in international business or in international marketing. So there can be smooth transactions, smooth deals between the business. Accounting standard have 32 accounting standard, whereas Indian AS have 40 accounting standard. Disclosure. Disclosure requirements are comparatively less detailed, while in Indian AS, the disclosure requirements are more comprehensive and multifold under NDAS. These are 40 in AS, means Indian Accounting Standard, which we have adopted. Now coming to the point, measurement of business income. How do we measure business income? We can measure income of any business by just revenue and their expenses. We can just do a total of their revenue and do a total of their cost, which is expenses. And when we subtract the expenses from the revenue, then we will know about the business income, that how much money we have made throughout the year or in a month. So that's how we do measurement of business income, by revenue or by expenses. We need these two things. And in revenue, sales of goods and rendering of service are the way to guarantee revenue. And if we talk about expenses, an expense is an expired cost. We can say that the cost that have been consumed in process of producing revenue are the expired cost. And the measurement of revenue and the measurement of expense is on the basis of, like, measurement of revenue is based on accrual concept, is based on accrual concept, like accounting period in which revenue earned is the period of revenue occurs. Therefore, a receipt of cash and revenue earned are the two different things. A receipt of cash and the revenue earned are two different things. Measurement of expenses, it is on current year basis, like, uh, if we are doing an expense, if we are purchasing something, then we have to put that in our accounts. It's on current year basis. But if we have taken or do some expense for further years, okay, which will benefit us in years, after some years, then we will not record it in current year basis. Objectives of measurement of business income, it works as a guide to future investment. Like, if we know about our income, then only we can invest in our business, invest more in our business. If it is profitable, then we can invest, and if it is not profitable, then we can withdraw our money out of the business. As a tax base, and after earning or creating or calculating the income of any business, then we can only tell that how much tax we have to pay to the government according to the government income tax, according to the income tax slab of India. As a guide to dividend policy, see how much profit should be retained by the business, and how much profit out of the income should be sent to as it is in the form of dividend to the shareholders. Is the point of discussion, and we can only do that if we calculate our income. As an indicator of managerial efficiency, as a measure of overall efficiency and creditworthiness. So, coming to the point, approaches for measuring income. Approaches for measuring income. Transaction approach, the balance sheet or value added approach. First one is transaction approach, and second one is balance sheet or value added approach. In transaction approach, first we record the transaction, like in the form of expense and revenue, and then measure it, and then we will measure the income. But in the balance sheet or value added approach, we create difference between the asset value in starting period and in the closing period. Like, accounting year starts from 1st April of every year and ends at the 31st March of every year. So we will define, or we will find that what was the value of our asset in the starting on 1st April, okay, and what is the value of our asset at the end of a year. Then we will balance it, okay. Whatever the balance come, if the assets rises, then we have created a profit, and if the asset comes less than the previous year, then it shows that we have a loss, that we are at a loss. That's what a balance sheet or value added approach. Accounting concept that is relevant to measurement of business income. Realization concept. So, realization concept in accounting, also known as the revenue recognition principle, refers to the application of accurate concept toward the recognition of revenue like income. And under this principle, revenue is recognized by the seller when it is earned, irrespective of whether cash from the transaction has been received or not. If the cash have been received, if the income have done or not. So yes, this unit is complete, I guess. Now we will move to the next block number second. Let me present you the second block. Okay. So in the second block, we're gonna learn about journal and ledgers, subsidiary books, trial balance. Basically, we comes to the practical part of the accounting. Now we will understand how we prepare our accounts or record our transactions. Just stay focused, okay? Journal and ledger. What is a journal? If anyone knows. What is a journal? Anyone want to try to explain journal? I guess no one is taking the initiative. So let me take the initiative.
Hello, ma.
Yes.
A journal can be simply a newspaper or a magazine.
Newspaper magazine. Is that what you said?
Yes,
No. I was asking in the terms of accountancy. Okay. In
um,
accountancy, when we record a transaction, when we record a transaction following some rules, okay, as per the rules, when we record a transaction like sale of goods, purchase of goods, then it is known as a journal. Every organization or any organization have numerous entry or transaction in a day, and an accountant have to record all the transactions, and where he will record all the transaction, that book is known as journal. It is the primary book or primary book of account. It is also called primary book of account. So a journal is called a book of prime entry, also called book of original entry. Okay, because all business transactions are entered first in this book. The word journal means a daily record. The word journal means a daily record. The transactions are recorded in this book in the order in which they occur. That is, they are entered in a chronological order. Okay, if a transaction happened, if the sale of goods have happened 3 p.m., then it will be recorded at 3 p.m. only. And if and the purchases of raw material took place at 5 p.m., then it will be recorded at 5 p.m. only. It should not be like that, like you are recording the transaction of purchases at 3 a.m., 3 p.m., and recording the transaction of sale at 5 p.m. No, it should be on time or in chronological order, whichever transaction have done. first. It should be recorded first. Is it clear?
I speak now.
Yes.
Um, in journal, does that mean one will not consider whether it is credit or debit? I will just record everything randomly. Is that what it means by
No,
journal
no,
means?
no, 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 no. As I said earlier, we have to record the entry as per the rules. Like if a purchase took place, okay, if a purchase, the purchase of raw material took place, then we record the entry like uh, purchases account debit, purchases account debit to cash account, to cash account. Here, purchases account got to debit and 2 is the symbol of credit. 2 is the symbol of credit. So we have to mention that while recording this thing. Okay. The process of recording a transaction in journal is called journalizing, and the entries made in the journal are called journal entries. And every transaction we record should have some documents or source document like cash memo, like invoices, bills. Okay, we only record the transaction which have happened and have some cash memo or some proof of the transaction. Now the format of journal. This is the format of journal. We have 5 columns in journal. See, the first column is related to date. Okay, the transaction, the transaction date. Okay, whenever the transaction took place, the date will be here. The second column is particular. The second column is particular, where I'll write purchases account debit to cash, purchases account debit to cash, and I will present the amount here, debit amount and credit amount here, debit amount here and credit amount here. And the third point is LF. LF is ledger folio. Okay, ledger folio. Because after creating a journal, we transfer the transaction or entry to their concerned account. Like if an entry have cash account involvement in it, then we will transfer it in the cash account. If any entry have a purchases account in it, then we will transfer that entry in purchases account too. So these are called ledgers. When we transfer in a particular account, when we transfer an entry in a particular account, that is known as ledger. So we mention the ledger folio or ledger page on which the entry is mentioned. Okay, on which page the entry is mentioned. So this is for that. This column is for that purpose. Just don't worry, stay focused. I will explain everything about journal. Okay, just stay focused. Now take an example. Sold goods for cash 500. Okay, being a business owner, you have sold goods for cash rupees 500 on May 2nd, 2018. May 2nd, 2018. So how will we record this entry? If you were in, if you were present in last class, then we discussed some journal. Okay, we discussed some journal entries like something is coming and something is going out. We have discussed the personal account, nominal account, real account. Anyone remembers those accounts? Types of accounts we have done like personal, real, and nominal. Whereas personal was related to the person, real account was related to the assets, and nominal account was related to the expenses and income of an organization. Does anyone remember that? Do anyone? I guess no one remembers that.
No, remember when you talked about the real account, you even gave examples. There was a table actually showing the differences.
Yeah, I gave examples like I provided some entries at that time. Okay, let's move further. Take the example here. Sold goods for cash rupees 500 on May 2nd. Now we have to create a journal entry out of it. The first point will be we have two accounts like goods, selling of goods, and for cash. We have two accounts involved in it. First one is goods, selling of goods, and second one is cash account. So in date column we write the date. We will left the ledger folio column as it is blank. In particulars, how we do entry like cash is a real account. Cash is related to real account, and real account motto was debit word comes in, credit word goes out. Debit word comes in, credit word goes out. And sale of goods. Sale of goods is directly related to income. Sale of goods is directly related to income. So in this scenario, in this entry, you are receiving cash and you are sending goods from your company. Okay, you're sending goods. So cash account debit, because debit what comes in, cash account debit to goods account, to goods account, to goods account, cash account debit to goods account. Here two shows that this goods account is being credited. Two is used prior to any account, then it means this account has been credited. Is it clear? And now the amount like 500 debit amount and 500 credit amount, because we have sold the goods of amount 500 and got the cash of 500. Is this entry clear? Is this example clear?
No, ma. You need more experience.
Okay. See, whenever we sell goods, then two accounts get involved in this. Okay, either see we can sell the goods on cash or on credit. We can sell the goods on cash or on credit, but in this case we have sold the good for cash, as it is mentioned clearly here. We have sold the goods for cash, amount 500. So in this example, we have two accounts involved in it. First one is goods and second one is cash. We get cash, we get cash against the goods because we have sent it the goods to the customer and we got cash against it. We got cash against it. So it was the role of real account which I have disclosed in the previous class, which I was which I have disclosed in the previous class. Like real account have a motto or have a particular account that says debit what comes in, credit what goes out. Debit what comes in, credit what goes out. So we have debited the cash account because in this transaction we got cash. We got cash and we have credited the goods account because we sent the goods to the customer. And let me take you the block first so that you can understand it in better way. Just wait. Wait for a minute. Now I'm sharing the block first PDF with you guys. As you can see, we have discussed it. Now you remember classification of account, personal account, real account, nominal account. We discussed it in previous class. We discussed this example as well, if anyone remembers. We discussed these entries as well. Now, you guys remember this?
Yes, you remember.
So this part is related to those journal, okay? Now let me present the book book of second block. So is it clear now how we create a ledger? We will discuss many journal entries in this unit, and you need to practice all these journal entries by your own too. Okay, I will explain journal entries here, but you need to practice them as well. Steps in journalizing. Like first, we record a transaction, take up the transaction one by one, read and analyze the transaction carefully from the business entity point of view, and identify the two accounts that are being affected by the transaction. Second step, you are aware that the accounts have been classified as personal, real, or nominal account. Okay. Each class of account has its own rule of debit and credit. Like the uh, personal account have the rule like debit the receiver, credit the giver. Then we have to play according to the rule. In 5.5, we will discuss the transaction of different types. Now stay focused. Okay, keep focusing. Transaction relating to purchase and sale of goods for cash. How we record a transaction of purchase and sale of goods for cash, not on credit, for cash. Suppose we bought goods for cash, amount 38,000. So we will create the journal format of journal account. Then we will record the transaction, goods account debit to cash account. Because in this transaction, we bought goods for cash. We have given cash, we gave cash to the purchaser or the retailer and got goods against the cash. Got good against the cash. So goods account debited to cash account. Goods account debited to cash account. And goods purchasing of goods is also our expense. Purchasing of goods is also our expense. Then it comes under the nominal account. And cash, as it is a asset, then it will come under the real account. So the rule of nominal account is like debit the expenses and credit all the income. Now, as it is an expense, then we have to debit it. Goods account debit And the rule of real account, which is related to cash, its rule is debit what comes in, credit what goes out. What goes out from our company, cash goes out from our company, so we are crediting it, and we will create this entry, goods account debit to cash account. Okay, when we sales good for cash, then we will get cash out of that, then cash account debit to goods account. Or you can simply think like that if we are purchasing goods, then the cash is going, cash is going, if we are purchasing good, cash is going and goods are coming. So you just can write it like cash account debit, and cash account debit, goods account credited, cash account debit to goods account, and you can present the amount here in both the amount section, debit amount section or the credit amount section. Here it is written purchased goods for cash from Ajit. Purchased good for cash from Ajit. This transaction is mentioning the retailer name. Okay, this transaction is mentioning the retailer name. But as it is already written here that we have purchased the good for cash, then we don't have any need of this name. We do not consider from whom we are purchasing the raw material or goods. We just do the entry same as we have done the entry of this transaction, like goods account debit to cash account. But if cash is not written here, or it is written as like purchased good from Ajit, purchased good from Ajit, if cash was not mentioned here and it was written as purchased goods from Ajit, then it will be considered as a credit purchase. Then it will be considered as a credit purchase. Okay, is it clear? Is it clear? I
Yes,
guess
ma'am.
yes.
Clear.
Okay. Transaction relating to purchase and sales of goods on credit. That thing only I discussed it here. Like now we are coming to the purchase and sale of goods on credit. Purchase and sale of goods on credit. Sold goods to Anand on credit. Bought goods on account from Ram. Bought goods on account from Ram. Purchased goods from Sham. There's no mention of cash. Okay, when there is no mention of cash and a person's name is mentioned, like from whom we have purchased the raw material, from, to whom we have sold the goods, so it will be considered as a credit purchase. And the entry of credit purchases sold the goods to Anand on credit. Like Anand's account debit to goods account. Anand's account debit to goods account. But if this transaction have done on cash basis, then the entry would be cash account debit to goods account. Cash account debit to goods account. So you can see the goods account entry is remained as same as in the cash account if the entry were done in cash. But cash is changed under the name of Anand account. Cash changed under the name of Anand account. So you just need to remove the cash account and put the name of the purchaser account. Put the name of the purchaser account. That's it. Your entry will be made. Same as the purchase of goods from Sham. If this entry was done using cash, then the entry would be purchases account debit to cash, purchases account debit to cash, or goods account debit to cash. 13,000 debit amount, 13,000 credited amount. But now this entry is mentioned under the credit section as the name is mentioned and cash is not mentioned here. Then we have to create this entry as like goods account debit to Sham account. We have changed uh, cash account by using Sham's name. Okay, by using Sham's name. goods account debit to Sham's account. You need to practice journal entries because this is the base of accounting. All the accounting parts, final accounting, trial balance, ledgers are based on journals only. If you learn how to create a journal, then it will all the accounts will become easy for you. Journals, basically, journal entries are, you can consider journal entries ABC of accounting. Okay, you need to learn how to create journal entries. So please do practice of journal entries after this class as well. Now, transaction related to return of goods. Return goods to Ram. Anand returned goods. Wait, we had some example. Yeah, sold goods to Anand. Here we have sold goods to the Anand, and Anand become our debtor. Anand become our debtor. Okay. Now Now Anand is returning some goods to us. Now Anand is returning some goods to us. Anand returned goods of worth 500, of worth 500. Then how the entry will be passed? We will get goods worth 500. Then we will pass an entry like goods account debited because we will receive the goods. Goods account debited to Anand's account. To Anand's account. To Anand's account. Okay, we have to credit the Anand's account because now he have to pay 500 less for the transaction we made earlier because he have returned the good worth 500. That's why we have credited the Anand's account. And if he paid for the account, then we will, if he paid for the entry he made or purchases, then the entry would be like cash account debit to Anand's account, cash account debit to Anand's account. If Anand have paid us, transaction relating to purchase and sales of good. Sorry, transaction relating to purchase and sales of assets. Now we are selling and purchasing our assets. Like purchased building, 1,75,000. Whenever we purchase a building or assets are directly related to real account, so you have to follow the rule: debit what comes in, credit what goes out. Whenever you purchase a building, the building get adds into your business, so building is coming, building account debit to cash account because cash is going. Debit what comes in, building is coming, and credit what goes out, cash is going out, so you can credit that. Building account debit to cash account. Sold old machinery to Joshi. Sold old machinery to Joshi, worth 1,500. Now as you can see here, nothing is mentioned about cash but mentioned the purchaser's name. In this entry, we have purchaser's name and there is no sign of cash. Then we will consider it as a credit sale. Credit sale. So the entry would be like Joshi's account debit to machinery account because machinery is going out from the company and Josh's account get debited. Josh's account debit to machinery account, and we will mention the amount here 1,500 and 1,500. Transaction relating to expense and incomes. Expenses and incomes are directly related to nominal account. Okay, debit all the expenses, credit all the incomes and gains, debit all the expenses and losses, credit all the income and gains. It is the rule for nominal account. Now coming to the point, paid salaries or wages. And what would our entry look like? Salaries account debit to cash account. Because salary account is our expense, and we have given cash against that. Salary is our expense, we have to debit it, and we have given cash against this. So salary account debit to cash. Salary account debit to cash. We have paid rent to the landlord Rajesh. We have paid land. Wait. Thank you. You mentioned it. Is it now? So there I was. Yeah, salaries. Paid salaries of 18,000 rupees. Now salaries are our expenses, so we have to debit it. Salaries account debit, and we have paid cash. We have paid in cash, so we have to credit it because cash is directly related to real account, and the rule of a real account is debit what comes in, credit what goes out, and here it is going, cash is going. So salaries account debit to cash account. They're not so complicated. If you try it by yourself, then you will for sure understand. Yeah, then you will for sure understand these things better in a better way. You just need to practice a little on journal entries. Transaction relating to other receipts and payments for cash, like paid to Ram on account or received cash from Anand on account. We have sold goods to Anand on credit. In previous example, we have sold goods to Anand on credit. Then he have sent some goods back to us, which was goods returned. Now we are receiving cash from Anand of rupees 9,000. So cash we get in cash account debit, because debit what comes in, cash is related to real, debit what comes in to Anand's account, to Anand's account. Anand's account is related to personal account because it's the name of a person. It's the name of a person. It is This account is related to a person. And what is the rule of personal account? Debit the receiver, credit the giver. Debit the receiver, credit the giver. So that's why Anand's account is being credited because he have given us the cash. So 9,000, 9,000. Let's move further. Transaction relating to receipts and payments by check. See, the difference only in transaction when we do transaction under check or cash. If we are doing any transaction with the help of check, okay, then we will transfer or hello, am I audible? Hello.
Yes, you are now.
Yeah, ma'am.
Okay, okay, okay. So, transaction relating to receipts and payments by check. The transaction will be created same, the journal entry will be created same, but instead of using cash in journal entry, we will use bank account. We will use bank account. Wherever we put cash in journal entry, we will replace it with bank account. Received a check from Shiva or paid to Ram on account by check. We have paid to Ram on account by check. Ram is our creditor and we have paid to him by check. So Ram's account debit, Ram's account debit to bank account. Ram is a personal account again, and the rule of personal account is debit the receiver, credit the giver. And Ram is the receiver here. Ram is the receiver of money here. So Ram account debit, and bank is directly related to real account. And the rule for real account is debit what comes in, credit what goes out. Our bank account is getting short after this entry, so we have to put bank account in a credit form. So Ram's account debit to bank account. If the entry was in cash, then we have to just replace the bank account with cash account. Is it clear? I guess yes.
Not clear, ma'am. Explain a bit about the 9,000 rands. Is it rands
9,000 amount.
or yeah? Like how does it go to credit and debit
Okay.
at the same time?
See, we are using a double entry bookkeeping system. Okay, we are creating a double effect. So the effect of one entry get nullified, and we at the end when we create balance sheet out of it, first journal, then ledgers, then trial balance, then our profit and loss account, trading account, profit and loss account, then our balance sheet. So for this process, we need to create a dual entry system. That's how we can know about our income. Because in balance sheet system, we just acquire the assets of a company from its starting place or starting time or starting year, and at the end of a year, what's the value of the asset of a company at starting, like 1st April starting of a year, and what's the value of the asset of a company at the end of a year. Then we will create a balance, or we will take them, or we will take a difference of them. Then we will know about the income. So that's why we have to do the entry in two accounts, like Ram account and bank account. Because when we pay to Ram, the two things are happening here. First of all, we are getting short of cash. Okay, we are getting short of bank because we are paying from our bank account. Then it will reduce our asset or bank. Okay, it will reduce our bank money. So first thing is that. And the second thing, when we are paying to the Ram account, it we have to show that we have cleared the Ram accounts bill. Okay, we have paid to the Ram, we have paid the amount which we owe to Ram, we have paid that. We have to show that too. So that's why we are doing this. That Ram account debit and two bank account. Ram account debit, two bank account. The amount of our entry would be same, like 9,000 and 9,000. Their total would be always same. 9,000 is going from our account, and 9,000 is receiving by Ram. 9,000 is going from our account, and 9,000 is receiving by Ram. So it's mentioned here. That's why we do a debit or credit amount. It will always be same, like 6,000 and 6,000. Suppose if there will be a more entry like 1500, then the entry will be 1500 and 1500. Is it clear now? That's why we put both the
Yes,
amounts.
it's clear.
Okay. Transaction with the proprietor. Proprietor means the owner of the business. Now, Ganesh commenced the business with a capital of 1 lakh. Okay, Ganesh commenced the business with a capital of 1 lakh. While discussing the personal account, I have mentioned that the owner's account is directly comes under personal account. Owner's account is the type of personal account. And the activity owners do, like when he invests in our business, then also it will come under the capital account. And if he withdraws, if he or she withdraws the amount, then as well, then the withdrawing amount or drawings amount drawings account comes under the proprietor's name. Okay. Now here, Ganesh commenced the business with a capital of 1 lakh. Now, business is a separate entity. Business is different from the owner. So, as a business, think like a business. While while creating or doing journal entries, always think like a business, not an owner. Think that you are the business. Something is coming to you and something is going out of you. Now, as a business, when Ganesh commenced business with a capital of 1 lakh, as a business, I am receiving 1 lakh rupees. I am receiving 1 lakh rupees. So, the cash account debit to capital account. To capital account. Capital account is directly related to proprietor, the owner. Capital account is of owner account. Okay. So, cash account debit to capital account. Now, coming to the drawings, he withdraws cash for personal use. Whenever your owner withdraws goods or cash for his or her personal use, then it comes under the drawings. So, drawings account debit to cash account 7,000 and 7,000. Always think like that you are a business. You are not the owner, you are business. So whenever your proprietor or owner withdraws anything from you, then it will comes under drawings account debit to cash account to cash account, because cash goes out from you. Cash goes out from the business. Transaction relating to cash discount. We will do that in a full-fledged illustration. Okay, I'll show you that there. Bad debts too. What are bad debts? Whenever your debtor are unable to pay you back. Okay, whenever suppose you have sold goods to someone. Okay, now they are unable to pay you back, then they will become your bad debts or bad debtors. Now illustration number 9, it's a full-fledged illustration. Please read it carefully first, then we will create journal accounts out of it. Ramesh commenced business on January 1st, 2018. His transaction for the month are given below. Okay. On Jan 1st, on January 1st, he commenced business with a capital of 1,50,000. So the entry, think like a business. You are a business, think like a business. So the entry will be cash account debit, because cash is coming to us, to capital account. To capital account. To capital account. Because owner is always the liability to a business. Owner's money is also the liability to the business. It's a business responsibility to repay the owner's investment. Okay, that's why we are crediting the owner's account, which is capital account. Cash account debit to capital account, 1,50,000, 1,50,000. Bought goods from Ajit and Company. Bought goods from Ajit and Company. Now tell me if it is a cash transaction or a credit transaction. First tell me if it is a cash transaction or credit transaction. Anyone? Or else I will ask. Alita. Alita. Please tell me. Bought goods from Ajit and Company. Is it a cash transaction or a credit transaction?
Come again with the question, ma'am.
Here it is written. Bought
Ma, ma,
goods
ma,
from Ajit and Company. Yes.
ma. To me, I think it should be.
Is it a cash transaction or a credit transaction? Have you purchased goods on cash or credit here? First, you need to
First, you need to
identify
identify.
the
Ma,
transaction before creating a journal entry out of it.
ma debit transaction.
Credit transaction. Did you say credit transaction?
Yeah.
Yes, it is a credit transaction. It is a credit transaction. First of all, cash is not mentioned here, first thing first. And the second thing is Ajit and Company. Ajit and Company name is mentioned here. Okay, the retailer's name is mentioned here and cash is not. So this is the sign that you have purchased the goods on credit basis. So the entry will be goods account debit to Ajit and Company, not to cash. Goods account debited to Ajit and Company, 35,000 each in debit or credit amount. Purchases account debited to Ajit and Company's account. Purchases account debited to Ajit and Company's account. Goods account and purchases account are same. We don't use goods word in journal entries. We always use purchases. If the transaction is happening in on credit basis or sale or purchase of goods is happening on credit, then we will use the account name purchases account or sales account, purchases accounts or sales account. If the goods we sell or purchase on credit basis, then we will use the selling account and purchases account accordingly. Is this entry clear now?
Yes, it's clear.
It's clear, ma.
Okay. Sold goods for cash. Here it is written. Sold goods for cash. It's already mentioned. So the entry would be cash account debit to sales account. Cash account debit to sales account, because we get cash in this transaction. As a business, we get cash in this transaction and we have to move or send the goods here. So cash account debit to sales account. Purchased furniture. Furniture is a asset. So furniture account debit to cash account. Furniture account debit to cash account. Now you will be wondering that why we have considered it as a cash, not a credit transaction, because nothing is mentioned here. Nothing is mentioned. In credit purchase, you will be given a name of a person from whom you have purchased or to whom you have sold. You will be given a name of that person. Okay. So purchased furniture, furniture account debit to cash account. Fourth entry, it is here mentioned here. On Jan 7th, purchased goods on account from Gotham and Company worth 18,000. Purchased Goods on account from Gotham and Company 18,000. Purchases account debit to Gotham and Company's account 18,000, 18,000. Returned goods to Gotham and Company. Returned goods to Gotham and Company. Whatever purchases we have made, some goods we are returning to them. So the entry would be like Gotham and Company's account debit to returns outward or to purchase return. To returns outward or to purchase return account, whichever you go like. Gotham's and Company account debit to returns outward. Returns outward is the second name of purchases return. Outward is the second name of purchases return. Returns outward because we are sending the goods back to them. Okay, as a business, the goods are traveling outside of the business. We are sending back to them. That's why. So this is how journal entries are made. Paid, paid for investment, paid for investment, advertisement, paid for advertisement. So the entry of this transaction would be like advertisement account debit to cash account, advertisement account debit to cash account. Are you getting the journal entries? You need to practice
Yes,
it.
ma.
Okay. But don't forget to practice the journal entries.
All right, ma. All right.
Okay. Now compound journal entries. Now you have seen single journal entries. Now we are doing the compound journal entries. Like when we call a journal entry
Excuse
a
ma.
compound. Yes.
Ma, about the credit transaction, I need
Okay.
more explanation about it.
Credit transaction.
Yes.
Suppose you have sold goods on credit to someone. Suppose you have sold goods on credit to someone. To someone. What's your name? Or let me take a name from here. Credit. See, here is the entry. Sold goods to Venkat. Sold goods to Venkat. Now, cash is not mentioned here at all. Okay, and also the purchaser's name is mentioned here, like Venkat. Sold goods to Venkat. So it is because it now becomes a credit transaction. It now becomes a credit transaction. In credit transaction, now we have two things. We don't in credit transaction we don't get cash. Okay, we don't get cash at the time of transaction. What is a credit transaction? When the payer promise to the pay, like we will pay you back after some time. Okay, now you will give us the goods and we will pay you after some time. That's what a credit purchase or credit sale is all about. You don't use cash in a credit purchase. Big firms or big organization purchase raw material on credit basis because it's not possible for an organization to buy or whole raw material on cash at a given time. So they need time to pay them back, and they have to run their business regularly. They have to create goods, they have to produce goods. So they do credit purchase, and so they sell on credit too. So they sell on credit too. That's what a credit transaction is. Now coming to the transaction or general entry, sold goods to Venkat. worth rupees 6,000. Now the entry will be like Venkat's account debit to sales account. If this transaction have completed or done under the cash, okay. If it is like sold goods of 5,000, okay, sold goods to someone. The entry will be like, so the entry would be like cash account debit to sales account. Cash account debit to sales account. But now it has mentioned that we have sold the goods to Venkat. Okay, and it shows that we have done a credit sale. So we have to mention the name, because why we are mentioning his name? Because we have to know that who we have sold the goods to whom we have sold the goods to whom we have to take the amount from. That's why we have to mention that purchaser's name, so that we can remember that he or she have to pay us, or they owe to us. Is it clear now?
Yes, ma'am.
Yeah, it's clear.
Now we were at compound journal entry. You have seen transaction which involve only two accounts. Sometimes a transaction may involve more than two accounts. Sometimes there may be more transactions of the same nature taking place on the same date. Okay. Now you have seen the single journal entries, like one account is getting debited and another account is getting credited. When when you debit one account and credit two or more accounts, then it will be considered as compound journal entry. Okay, when you will debit two or more accounts and credit one account, then it will be considered as compound entries. When you debit and credit several accounts at a time, then it will become known as a compound journal entry. As above, you have seen only single account debited and a single account credited in every transaction. As you can see here, one single account is debited, one single account is credited. One single account is debited here and another single account is credited here. But when two or more accounts is credited and one account is debited, then it is will be known as compound entry, or vice versa. I will show you the entries here like this. Paid cash to Ganesh rupees 490. He allowed rupees 10 as a discount and settled his account. So Ganesh was a creditor. Ganesh was a creditor. We owe to Ganesh. Now, while paying 500 rupees, he gave us the discount of rupees 10, and now we have settled down in 490. The entry would be like Ganesh account debit 500, Ganesh account debit 500, to cash account, to cash account 490, because we have paid only 490 rupees. To discount received account 10, to discount received account 10. Now there's a thing you need to consider, that this is the debit amount, this is the debit amount, and this is the credit amount. In journal entries, it's always the first one is the debit amount and the second one is the credit amount. Now the sum of them would be the same, like 500 and 490 plus 10 would be 502. The total would be the same. The balance between debit and credit should be the same. There must be a balance between debit and credit. Is this clear? Now we can call this a compound journal entry. A compound journal entry. Okay. Now, sold goods to Rao and Sons rupees 800 and Sharma Bros rupees 500 on May 5th, 2018. On a day, we have sold goods to two companies. Okay. Now, if we want to, we can create separate journal entries of both of them. But if we want to create a single entry, then how we can create? Rao and Sons account debit 800, Sharma Bros account debit 500. Two sales account 1300. Two sales account 1300 because we have sold goods of 1300 in total. And as I said earlier, the total of debit and credit side must come equal. So that is known as compound journal entry. Opening entry. Whenever a business gets started, okay, whenever a business gets started, whenever a person commences the business, or at the time of starting of financial year, at the time of starting of financial year, we do a opening entry. We create an opening entry. Or whenever we purchase a running business, then also we create a opening entry. How it looks like, Mr. Avinash has following balance of assets and liabilities on December 31st. On December 31st. Now, on 1st January, we will create new account or will get in a new financial year. We have two types of years, like January to December, where we can start our year from 1st January and end the year at 31st December. Or we have one accounting year. Why it is a accounting year? Because in accounting year, we start our year from 1st April from 1st April and ends our year with 31st March. Ends our year with 31st March. That is known as an accounting year. Here, it is not considered as an accounting year because it's the year ending is 31st December. Now, coming to the point, illustration number 11, we have some balance. Cash in hand 2500. We have furniture worth rupees 500. We have stocks of goods worth 22,500 and a bank loan too, which is of worth 10,000. Now we will pass an entry on 1st January. On 1st January, pass the opening entry on January 1st, 2019. How we will pass it? See, cash account debit, stocks account debit, real account, it's related to real account, cash account, and furniture account debit, two bank loan account, two capital account. Cash account debit, cash is a real account and we have a positive balance like 2500 cash in our hand, so it become our asset. Okay, it's with us. Cash account debit with 2500. Stock account, the raw material we already have, it is also our asset. Then debit word comes in, so stock account. Furniture account, furniture is also our asset. We have to play the rule, debit word comes in, so we have to debit the furniture account. We have furniture of worth 5000 and we have a loan as well. We have a loan as well of rupees 10,000. It is our liability. It is our liability. We have to pay back the loan. So to bank loan account and the remaining account, the remaining amount will be transferred to the capital account. Will be transferred to the capital account. See, 2,500, 22,500 and 5,000. 25 and 5, 30,000. The total of the debit side is 30,000. Now out of which we have a liability which is bank loan. We have credited it here as mentioned 10,000. Now remaining the 20,000. Now remaining the amount 20,000, it will be considered as the capital account, means the money of owner. The money of owner. So the capital account will be credited with 20,000. Casting and carrying forward. Yes, Alita.
Madam, how did we know that the 22,500 rupees is a loan? Because
It
it's
is
saying stock of goods. So, like, how can you know that it's a loan or not?
uh, see, the stocks of goods is 25,500. Stock of goods, stocks are always your assets. And if they are not a loan, it will be mentioned here that a credit balance or a debit balance, because it's a starting of your journal entry. Now we are not complicating it with debit or credit balance here, but in further units you will see it will be mentioned that a balance, okay. The capital account will be shown a debit balance or a credit balance, and we will perform accordingly at that time. We will perform accordingly at that time. And the thing of loan is it is mentioned here. Bank loan is mentioned here, and loan is always our liability. Loan is always our liability, so our capital is. Capital is also the liability of a business, and loan too. From wherever we are getting money in business to run our business, except selling the goods, from wherever we are getting money, like we are getting money from shares, it's also the liability of business. We are getting money from the owner, it's also the liability of business. We are getting money from the bank account or the from the loan, we are taking loan from anyone, then it's also the liability of our business. Think from the perspective of business only, don't think from the perspective of owner. While creating journal entries or while doing accounts, preparing accounts, think from the perspective of business, because business is a separate legal entity. Business and owner are two different things. Is it clear now?
Yes, it's clear. Thank you, madam.
Casting and carried forward. See, guys, if you have this book or whichever study material do you have, now you have to read the illustrations of journal entries, because it's not possible that we will go through the every illustration. It's not possible for us to go through every illustration, and for practice you need to do illustrations. So either download this book, or if you have the study material, read from there, do practice from there. Once you will get a hold on journal entries, then you can do mastery in accountancy. Journal entries are not so difficult as it seems in first place, okay. So after creating a journal, after preparing a journal, we transfer the journal entries to the ledger account. In ledger we have separate account for every entry. We have separate account for every account, means like sales account, purchase account, machinery account, furniture account, cash account. Now, as you can see, the furniture account to cash account, like being purchased an almirah for rupees 450, cartridge paid rupees 30, so the total amount would be 480. So the entry is furniture account debit to cash account, because furniture comes to our business and cash goes out from our business. Now, after creating this entry, now we have to transfer it in ledgers, in ledger. Now how do we transfer it in ledger? We transfer furniture. First, we transfer this in furniture account. Furniture account by mentioning to cash. By mentioning to cash. And we will mention this in cash account as well by mentioning by furniture account, by crediting by furniture account. I will show you how to do that. Before transferring the account, first you need to know the format of ledger account. This is the format of a ledger account. Here At the top of the account, the name of the account is mentioned, like purchase account, sales account, machinery account, furniture account, or whichever account you can create. Okay, it is the partition. This line is the partition, and the left side is considered as debit side. Left side is considered as debit side, and the right side is considered as credit side, and it's also written here, debit or credit. In debit side, we have four columns. First one is date, second one is particular, third one is folio, which is JF, journal folio, and it will tell you that this entry is mentioned in on that page on in journal accounts. Okay, in book of journals, and the amount and the amount. So here, same with the right side or credit side. Now we will take an illustration. Illustration number 13. Purchased machinery for cash 50,000 on April 4, 2018. So the journal entry for this transaction would be machinery account debit to cash account. Machinery account debit to cash account, 50,000 debit amount and 50,000 credit amount as the amount is mentioned here. Now, after creating or presenting it in journal entry, now we have to transfer it in ledger. Now we have to transfer it in ledger accounts. So we have to create two accounts. We have to create two accounts. First one is machinery account and second one is cash account. First one is machinery account and second one is cash account. So coming to the first part or first account, which is machinery account. Now you can see machinery account is debited. Machinery account is debited means we have to go to the debit side of machinery account. We have to go to the debit side of machinery account. You can see it here. It is the debit side of machinery account, and we just put that the to cash account, because in machinery account we can't use the name machinery. Like we can't say that machinery account to machinery account. No, the entry is machinery account to cash account. Machinery account to cash account. It shows, this entry shows that uh, worth of rupees 50,000 or using cash rupees 50,000, we have purchased a machinery. We have purchased a machinery. It shows it here. And coming to the part cash account, as you can see, cash account is credited here. Cash account is credited. So we have to go to the credit side of cash account. We have to go to the credit side of cash account. And in there we have to write it like buy machinery 50,000. Now, debit side of any account, remember, of any account, the entry will be mentioned as with a prefix which is to. The entry will be mentioned with a prefix of to. But if we are doing it an entry in credit side, then we will have to use a prefix by, like we have used it here, by machinery. I'm explaining it again, or let me take another entry. See, paid salaries of worth 6,000. Salaries account debit to cash account, it's journal entry. Salaries account debit to cash account, it's journal entry. Okay, 6,000 and 6,000. But when we create ledger, so in ledger, we can see salaries account debit to cash account. So first one is cash account. Salaries account debit to cash account. As it is a cash account, so cash account is credited here. Salaries account debit to cash. You can read the entry, salaries account debit to cash. Cash is being credited here. So we are going straight to the credit part and mention that cash account is credited by salaries account. Cash account is credited by salaries account. By salaries account worth 6,000. And in salary account, as salary account has been debited, then we have to show it on debit side here. That's how we transfer journal entries in ledgers. Posting a compound journal entries. Like on May 31st, 2018, Mohan, a customer, paid cash rupees 950 in settlement of his account of rupees 1000. In settlement of rupees of his account 1000. So he have to pay us 1000, but we have allowed 50 rupees discount and he paid only 950 to us. Now, cash account debit. See, if someone owes us something and they settle the account, if they settle the account, we always think that we have either get a discount from the person or either we have allowed the discount to that person. So in this, we have received cash of worth 950, cash of worth 950, and settled the account of Mohan to Mohan of worth 1000, and the difference comes of rupees 50. Then it will be shown like discount allowed account debit, discount allowed account debit, because it is mentioned here that we have settled his account. It is mentioned here that we have settled his account. So cash account debit, discount allowed account debit to Mohan account. Now we will post this or transfer this entry to its ledger. In this entry we have three accounts. First one is cash account, second one is discount allowed account, and third one is Mohan's account. So cash account gets debited here. So we will transfer this amount in the debit side of cash account. Debit side of cash account to Mohan. To Mohan, which is 950, which is 950. Now coming to the point, discount allowed account here. Discount allowed account here is also got debited here. Now when we transfer that in the ledger of discount allowed account, on the debit side, and we will mention to Mohan 50 rupees. To Mohan 50 rupees. Coming to the Mohan. Mohan got credited here. Mohan got credited here. So the Mohan account would be like by cash 950, by discount allowed 50. By cash 950, by discount allowed 50 rupees. That's how we transfer a compound journal entry to ledger account. That's how we post it. So yes, balancing ledger account. Balancing ledger account. How do we balance the ledger account? We have an example here. Look at the Pankaj's account in illustration 14. We have to go back to the illustration number 14. So you will find that there are two transactions, one on each side. Pankaj has been debited with rupees 1000 for credit sales to him and credited by rupees 4000 for the amount paid by him. The difference between the amount debited and the amount credited is rupees 6000. This amount of rupees 6000 is the balance in his account. We just see the account here. Okay, this is the Pankaj account, and we have done sales. So Pankaj account debit to sales account. We have did credit sale to Pankaj. So the entry would have been like credit sales. Sorry, Pankaj accounts debit to sales account. Wait a minute. Okay, guys, this is the last topic of today. Okay, of today's class. Now, first understand this thing. Okay, we have sold goods to Pankaj on credit basis. So the entry could have been like Pankaj account debit to sales account worth rupees 10,000, and he have paid 4,000 in cash. So cash account debit to Pankaj account would be the entry. Now we will balance. How we will balance a ledger account? We will look here. So first of all, we have to look which side is greater, debit side or credit side. Debit side 10,000 or credit side with 4,000. Which side is greater? Of course, the debit side is greater because it has 10,000 rupees. So we will create a balance here like 10,000, mentioning the rupees 10,000 on each side, debit or credit side, debit or credit side, and shows the balance here by writing by balance carried down, by balance carried down. Or if the balance have come here, then we have to write like two balance carried down, two balance carried down. Okay, by balance carried down, and the difference between that. Now as it is showing, whenever the left side of any account is greater, then it shows the debit balance, and whenever the credit side of any account is greater, then it shows the credit balance. Okay, here the debit side was greater because it has worth of rupees 10,000, so it is debit side. Okay, debit balance, it is considered as debit balance. So that's it for today. Now I am concluding this class. Please do practice of journal entries and ledger accounts. In next class we will be doing the unit 6. We will start with unit 6. Okay.
Okay, ma.
All right.
Okay.